Hi everyone, welcome back to my channel. This is part 2 of my volume price analysis series. I wanted to shift gears a little bit, and instead of focusing on trading ETFs and futures such as SPY, QQQ, ES, and NQ, I'm going to show you how to use the Tradytics TradyFlow to find a solid play and discuss getting the most out of that play on an intraday chart using volume price analysis, and in particular this time I want to focus on volume profile. If you'd like to get a 10% discount for Tradytics, don't forget to use my referral link in the description. Also, if you enjoy this content, don't forget to like and subscribe to help me grow this channel and get this information out to more people. I love doing this. I'm just trying to put the best information out there possible. So in this video in particular, I'll be calling out some of the fake guru tactics I see used and discuss why they're bad and what should be done instead. And if you haven't already watched volume price analysis part 1, make sure you watch that first to help fill in some of the blanks, and then come back to start this video. So as you can see, I've already logged into Tradytics here, and over here on the left hand side, if you go to TradyFlow, this is one of their AI algo tools that they have that can look at live options flow, and it helps call out the most interesting plays. And you see a lot of good stuff pop up here every single day, and I want to talk about not only finding these plays but picking out the best ones and then acting on those plays. So if we scroll down here, I already have some filters selected, and I just want to talk about those briefly. So in this case, because I prefer to trade intraday, I'm not really looking for swing plays, I have these filters selected, which are short-term consistent winners, which is actually a really cool one. Apparently there was some back testing done, and if you choose this consistent winners tab, even if you did nothing else, you just played them blindly, apparently they have like a 60% win rate, which is pretty huge. So, you know, ideally by applying volume price analysis, we can get that win rate even higher. And then I want to only look at orders. I'm not looking at 1 million in premiums because that doesn't really apply to all tickers. That would only be large cap stuff. So, but I do want to see ones with multiple orders. So I chose 10 plus orders. And I wanted to make sure that it wasn't already an expired play. I want to do stuff that is active, that potentially whatever whale is pumping this money into this play could still be in that play. So then one other thing I have chosen here is volume greater than open interest. Now you don't have to choose this. I just prefer to choose it because when volume's greater than open interest, if you don't already know, open interest is basically how many contracts on the market that are out there that have been bought or sold to open and are still open by close of market, and those numbers get updated every day at close of market. Now if you see volume exceeding that, it means that that particular options chain is very popular. It means more people are buying and selling it than it actually had open going into the day, which means chances are that's also going to be opening more contracts on that chain. And also it typically makes it a good a day trading options chain, which is what I'm looking for here. And so I mean, you don't have to use that. Another thing you can choose to do is you can, if you want, you can choose still out of the money, meaning that the options play hasn't gone in the money yet. And that's pretty nice if you see like a speculative trade like the one shown here where the strike is pretty far out with a short expiration. It's not a guarantee that it's going to actually reach that strike, but it could in some cases. It could mean that like someone knows something and there's some big news coming up and there's going to be a massive run up soon. So it's something to consider. In this case, I'm going to leave it off. If you do choose to leave it on, I would definitely uncheck volume greater than open interest because you just want to make sure you get enough results to go through. And again, we're not playing all of these, so we only want to pick out the best ones. So if I turn this off and turn volume greater than open interest, let's start going through these, and you'll see right away we have IWM. Now that's an ETF, which we're not going to be covering in this video. And that's also a cool feature. If you hover over these, you can actually load the daily chart, which is very useful. Of course, it's not loading now that I said that, but you might have just seen it a moment ago. Now, we're not going to choose IWM because I choose to play that with futures or day trading like I would SPY and QQQ. That's the Russell 2000. It's small caps, and I trade those differently. Again, I talk about that in part 1 of volume price analysis and also in some other videos where I use gamma exposure and things of that nature to prep. Now, if we go down to look at these other plays, we have BBY, so let's just pull up that play real quick. And so we have the daily chart up, if we go to the 3-minute, you can see it's a really gappy chart. Like I mentioned before, when I'm doing the intraday trading, I tend to stick to the 3-minute chart. And when I see big gaps like this, right away it tells me there's not a lot of volume. It would be really difficult to play this. I don't really like the look of this chart right out of the gate, so we're just gonna skip that one. If we go to TTWO, we can see calls at the 145 strike. Let's pull that up. 3-minute chart. Yeah, this one's even worse. So, I mean, you can kind of see some patterns in here. You can see where volume's coming in at, but again, way too gappy. And this is one thing that you should always consider that I see, again, when I was talking about the fake guru stuff I mentioned. When you see gappy charts like this, chances are if you look at that options chain, there's gonna be really wide bid-ask spreads, which means that a lot of times if you were to even buy into this, so if you were to buy a call to take this, you'd already be down like $50 per contract just because the spread was so wide on these low volume plays. So let's go ahead and skip this one as well. And let's go to MRVL. So yeah, okay, so this is a much better looking chart on the intraday time frame. This is one that we can use. So without jumping right into it too quickly, let's take a step back to the daily. And what we're going to want to do is we're going to want to determine our levels. And we talked about before, I mean, we went over gamma exposure, which I'll touch on again, and we talked about price action and volume at time, which is the volume bars down here. You can also see they just recently had earnings, so this would be an awesome post-earnings play, and I'll talk about how we could have played this on Friday post-earnings. But if we look in here, so I just want to show you my indicators. So you can see I have volume, and then there's two types of volume profiles. Now, if I'm using TradingView here, and I realize not everyone has a paid subscription, so I want to give people some options. This volume profile is a free version of volume profile. It works great, and it has everything we need, where you can see the ledges, so the low volume nodes, the high volume nodes. You can see what, and I'll do a whole video on volume profile, but this is just kind of like entry level to get an understanding of how to define levels. You can see it has a POC, and you can see typical patterns we would expect to see with a volume profile, which in this case would be what they call a B, which can, you know, the multiple parts sticking out like this shows, you know, where volume was coming in and dropping off during this downtrend that it was recently in. And now we're starting to move back up, especially when volume dropped off. We kind of stabilized and we're moving back into the higher volume areas, which is definitely interesting. This is the free volume profile. Now, if you do pay for TradingView, which I do have a subscription myself, you can actually use, if you go to indicators, the free one I was just showing you, you can find here under volume profile, or the pay for ones also show up here. You can also go to technicals and choose volume profile, and there's a couple different types. Now, in this video, I'll be using visible range volume profile because I want to see the volume profile for the range that we're looking at. Now, if I was trading the intraday chart, another option would be the session volume profile, which shows up here on the left and shows you the volume for the entire session, which is also very useful. And I actually recommend using both if you have the pay for version, because you can get a lot out of both. And like I said, we'll get into that in another video. So, but for now, for our analysis in this video, I'm gonna take off the session volume profile because you can see it doesn't show up on the daily chart, which is what we're gonna be using to define a lot of our levels here. And the other thing I want to know is you have a bunch of big blocks here. I want better info than that. So I'm going to go into settings and set row size to 300. And we can leave everything else the way it is. Value area, it just shows the area where 70% of volume was conducted. The POC line, you can choose to change the color of that, which is where the most volume was conducted in this visible range. And then up volume and down volume, which is kind of misleading. It's actually more bid volume and ask volume. And one thing to note too, a lot of people don't talk about, a lot of people just assume ask volume is buying volume. That's not true. Ask volume can also be a market sell, just like bid volume is not solely selling volume. That can also be a market buy. So those are things to consider there. But here it shows up volume, down volume. You could even change it to be the same color if you want it. We don't really need to get in that, but I do want to do the row size just to get more details here. And now you can see I can see my low volume and high volume nodes much better. So just jumping back over to Tradytics, if we go to the ticker dashboard, we're going to want to pull up MRVL and see what we can see here. So let's search that. And one nice thing about this tool, I mean, you can start plotting levels. I have another video where I discuss this, where you can actually plot dark pool levels. You can plot support resistant levels, and this tool does a really great job at finding those levels. So if you go down to the 1 minute, because we're doing intraday trading, and you say support resistant levels, you can plot all these levels on the chart, and they will, and you can see how well they hold up just looking at this chart. And it is based off flow. But since we're looking at calls, we also want to make sure if we look at the net flow for this ticker, you can see puts have been flat, which is great, and calls have been on the rise, which is also great. So this play is looking better and better the more we look at it. You can see call versus put volume. Call volume is on the rise. Call open interest is on the rise. All good signs. You can dig into the heat maps if you like, see where the most open interest is targeted, and that's really interesting. So if we look back at MRVL, we are currently at 60.82. A lot of open interest at 70. So this could truly be a target. Now, we're not sure what the expirations are on those, but again, this is where you can start looking at the heat map up here to try to get a read on that. And you can see, so July 15th and June 17th. So yeah, I mean, that's great. This is short term. We have a lot of open interest in and around the 70 strike. So there's a good chance there's something going on here, and this is a great ticker to play on the way up. We can also, of course, if you've watched my other videos, you know I love my gamma exposure. You can see all of the gamma is above the 0 line, so it's a positive gamma environment, meaning that we are currently pushing it up with a ton of gamma exposure right at 60, which is right around where we ended for the day. Now, gamma exposure itself, when we're playing individual tickers like this, individual equities, it doesn't play as big as a part as it would with ETFs or futures, but it still plays a part. And the fact that we have positive gamma exposure means that this ticker has a good chance of steadily moving higher. So, all right, so we have our one of our tickers we want to play, and I would recommend doing this process every night and looking at TradyFlow from the day before, picking out only the best plays and trying to keep your watch list to maybe 2 to 4 tickers at the most. Even having one is fine, right? Because you don't want to spread yourself too thin. You want to catch the best move that you can. And so let's rewind, and let's say that we had seen this play after earnings. So it's 526. We saw the positive earnings, and we wanted to play at 527. And now this is where, again, we start getting into the fake guru talk, where you'll see fake gurus, they'll look at levels and they'll say, okay, if we'll take calls if we go above 60.53, because I see some areas where we have resistance there. And remember, on this day, this opened up right at 60. So they'll say take calls if it goes above 60.53, and then with no conviction at all, everything we just looked at is showing that we're only concerned with calls. If it starts going down, in reality, we need to scratch this play because we don't understand why it's going down. But they would say something like, and you can see there's a big level that held here, so they would say something like, if we break 59, take puts, right? And that would be the way they play it. And the reason why this is bad and why not having conviction like that is bad, because let's take a look at this chart for a second. And look, right out of the gate, so we break this level that they were saying take calls if we break, and boom, it instantly rejects. It looks like we break it, you take calls, it rejects, you hit your stop loss, you lose money. But you're like, okay, well, maybe I'll take puts and make that back. Boom, it breaks that lower level, instantly holds, and again, you lose money. And that happens again and again. And that's not how you want to play these. And I hate when I see that, and it's all over Twitter, unfortunately. And it's just not the right way to play something. It costs a lot of people a lot of money when you see people talking about playing these things with no conviction. Take calls if it's above this, puts if it's below that. we don't want to play breakouts. We actually want to use volume price analysis, like I discussed in the part 1, the video I made last, and we want to play level holds. And once we have conviction, we know this thing's going up. You know, for the sake of this video, we haven't seen this day play out yet, but we know we just had good earnings. The options flow all looks very positive. TradyFlow pointed out that there is some unusual options activity centered around calls. So we want to figure that out. And now, so going into the day, you can see in the pre-market, we gapped up off of earnings. And so what you should be doing is using volume profile and using price action on the chart. You want to say to yourself, okay, at what level can we expect to see this thing hold? And then at that point, if the candles look right and the volume looks right, I'm going to take calls, right? So we don't just want to chase it out of the gate. If it just gaps and goes out of the gate and runs without us, then it runs without us. We missed the trade, so be it. There will always be more trades. Chances are you'll have more than one on your watch list, but even if you don't, there will be trades the next day. Do not chase. It's one of the worst things you can do. So instead, what we want to do is we want to say, okay, so if we're going to be opening right around 60, at what level can this come down to, and then I'll play it up. So again, I do really like this candle because of how we touched down and it shot right back up. And now we need to make sure that it actually matches with volume profile. So what we're looking for is ledges. So we're looking for low volume nodes and high volume nodes, and where high volume nodes fall off into low volume nodes, those are likely going to be our levels. So if we're thinking entry level here, then what we want is, so based off this candle previously, and you can see this high volume node, right? This puts us right around, I guess it would be right up here actually. So 58.46 roughly would be a good level. We could set one lower just in case we see it fall all the way through, but so 58.46, and then we can also plot levels above, like where we would expect to take profit. And again, so we have this gap here, this low volume node gap, so we could expect to take some profit right around here. And then we have a POC on the daily. That's always going to be, this POC is typically going to act as a point. If price is under it, it will be a point of resistance. Price is above it, it will be a point of support. So we'll definitely mark that one. And then we don't really, like at this point, I mean, we had this gap down. We could mark some other levels below, but of course, if this thing starts falling too far below, then we just want to scratch the play unless we do see it come back up. But we're going to make our trigger level that, so actually at this one, let me just line this back up here. 58. Sorry, let me put these back on again. Yeah, there we go. This ledge. We have the POC resistance. We have another level right here, right in that gap. So that should be good now for the sake of this demo. And so the way it would work is, and what you're looking to do is, so this level that we talked about, this 58.86, we would want to mark this in advance on the daily as like our entry level. So if we see that level hold, we want to take calls, right? So, or if we see price go under it and come back up based on volume price analysis, so volume at time and then the type of candles and the wicks that we're getting, and we discussed in the last video. So if we're seeing bull hammers or shooting stars, spinning tops, whatever you might want to call them, those are great entry candles if we see it hold on our level. So we'll mark it green. We know that this POC that we had there is going to be a tough resistance level, so we could mark it as red if we wanted to. Not fully necessary. And then so what the way you would play this is coming in to open. And now sometimes you can actually, you know, I was kind of hoping that I would have more data off this pre-market, but it's very gappy, so I don't, because oftentimes you could set your entry trigger like the pre-market low is always a great entry trigger if you're looking for calls, or the pre-market high is a great entry trigger if you're looking for puts. But you could see we would open, we'd shoot right through this level, and right away you're going to be thinking to yourself, oh man, like I'm this trade scrapped, you know. But the opening range, especially, you have all this volume, you need to be patient, right? You don't want to get chopped up in all this volume right here. So it shoots up, and right away it starts coming back down, and we know from our daily, this is our entry level, and this is our take profits level, which was a very high volume node, POC node, point of control node. And so when we start coming back down, right away you actually get this nice green candle. Now, even if you didn't play this and it comes back down, when you see this candle and you see this wick start to form again, this is a great entry point. And so, and one thing I want to point out is this candle is very high volume. These candles weren't nearly as high coming down, and the reason why this candle is much higher volume is because that's what we call stopping volume. So you see stopping volume come in right at your level, and then you see a green candle, and you can even set a limit order to try to get in right here. Now, it's kind of difficult because of implied volatility, but when you see it touch this level again and start moving up, great entry. And you can choose to take profits at this level, or if you want to be a little more aggressive, you can wait until we see, once again, candles with stopping volume, which this candle right here, if you're not taking profits at this candle, you're doing it wrong. But this move right here, like say if you got in right at 59.03ish and you got out right around 60.50, I mean, you just made $1.50 profit. That's a significant profit. And then sure enough, so you exit out and you let this stopping volume play out, things start to stabilize because we're out of the opening session, and then we actually come below our entry level, but you get a bull hammer, or actually more of a spinning top shooting star candle, which is a very bullish candle. Despite it being red, you can see we got down here and it all got balled up, and then we start moving up. And once again, I mean, you could take it the same way you did before, where you see it move up, you set a limit here, some right around here, you get caught again, sure enough, right off your level, you take it up, and then you start seeing wicking out, and you can get in. And then you could even get a third entry. You know, at this point, this is really nice because now we just made a higher low. So like we had this low right here. Now we're not even coming down as far as we were before, and we're going to start gradually pushing up. And we're doing it on lower volume, and this is where I want to talk about other things to look at, because you don't want to just base it off this chart. In TradingView, if you come up here, what I would always recommend doing is having up SPY and QQQ right next to it. And the reason being, and let's just line up these indicators here. And you should have levels on SPY and QQQ, honestly, especially if you plan on playing them throughout the day along with whatever it is that you're trading. But for this case, just for clarity, because my screen's smaller, I'm gonna remove them. Now you could see these tickers act as extra confirmation, and in particular, so if we go, you know, when we're seeing this level hold right here, and we're seeing that SPY and QQQ overall has been bullish, we're not really concerned, you know, if it's going to get stuck at a level. We're looking at it in general to see if it's bullish, and you can see it's been moving up. The market itself has been moving up, and you can also use market net flow for this, right? So if market net flow on Tradytics is bullish, it's just extra confirmation that this ticker is going to hold these levels. It's going to respect all the bullishness from the research you've done when you're in your technical analysis, and it gives you extra confidence to play your calls off of your level when you start seeing it push back through your level. And once again, so if we come down, right, so we see SPY and QQQ right at the same time came down at the same time we came down here, and they start moving up, and here we're making a lower low, even though it's not exactly at your level. And again, you can use volume profile for this. You can see we're starting to get to this lower volume area, which again, these lower volume nodes act as zones of support if they're under the price action, and they also act as zones of resistance if we're above it. And so we get down to these low volume nodes, and we know this zone of support is likely going to help hold us up, especially while we see the market continuing to move up. So if you were to get into calls here and you're patient and you do your take, it's low volume action. So, I mean, you really need to be patient here. I don't blame anyone for getting out, but if you're using volume price analysis, you can see every time that we're pivoting down with red candles, it's on diminishing volume, and then we move up on increasing volume, lower volume, increasing volume, and we're sort of chopping around, but we're not making lower lows. So there is the incentive to stay in there, especially if you see the market still looking bullish. And then eventually we just break away and we really make a run for it. And at this point, we start seeing this momentum. Now, me personally, if I were to see a candle like this, I would get hesitant. You can see the lower volume candles, volume dies down, and then we start moving up again. But no matter what happens here, once we get to this level, that was that POC, that high volume node that I marked on the daily from the volume profile, once we get here, I'm taking profits no matter what. And if I haven't already, again, we never make a lower low, and we keep going up. And so basically what happened is our one trigger entry that we were patient with, that we set using basing it off volume profile and volume that we saw on the chart, and levels, key levels that we saw hold. This candle in particular was a massive entry. And I mean, if we go back further, we'll see, at one point this was actually resistance, and then it became really, really strong support. And then it got broken through with a bunch of chop, and sure enough, now it's acting as strong resistance again. But we confirmed that with volume profile, and because we were patient and we waited for the open to come down to our level that we have confidence in, combined with what we saw on the options flow dashboard, we now took 1, 2, 3 successful trades. Two were quick scalps. This one was bigger than the second one, but this move right here would have been massive, because even if you got in a little late, like you wanted to see SPY and QQQ shift to green, what you can see happen with this pattern here. So this on both of these, QQQ shows it really well. We come down, and then this green candle, we get stopping volume here, and this green candle pushes us up on higher volume. We get a second candle on that second green candle. So even if you waited for that to get in, you got in around like 59.07-ish, and you took profits at the POC that we marked from the daily, 61.29. I mean, that's a really solid day. I mean, you had 3 profitable trades. You were using market awareness and volume price analysis and being patient with your levels and playing levels properly. You're not playing breakouts and losing money when they reject. You're playing holds when you're confident, when you see volume and candles indicating that the level is holding, and you're entering in. You're not rushing to enter in. You're not rushing. You're sitting. You see it coming above your levels, and you want to enter in with limit orders and let them get picked up. And yes, that will cause you to miss trades from time to time. That's the unfortunate reality of limit orders, but it will save you from losing trades more often than it causes you to miss trades. And so I think I can wrap it up here for this video. Hopefully that helps a lot of you on how to properly play these. Just when you see people saying take puts below this level and calls above this level, they're burning a lot of people teaching people to trade that way. It needs to be off level holds. It needs to be patient. It needs to be disciplined, and having set profit targets above you is also a great way to ensure that you lock in profits. Catching the whole move is unrealistic. Usually if you're holding through certain patterns, and okay, yeah, you get more money by holding through it, but you're risking giving up all your profits. So what you can do to capture a whole move like this is you can keep sliding your stop up, which is what I would recommend. So when you get to a profit target and moves up, so as we're moving up here, your new trailing stop would be right here. And then as we make another pivot and we move higher, your new trailing stop could be here, and it pivots, moves higher, your new trailing stop would be right here, and we get close to triggering it, but then we move a lot higher, and at that point you just keep moving up, pivot after pivot, and that's how you actually go about properly catching this whole move. And at any point, if it were to drop back down and trigger your stop, stay disciplined and hold it. You can also scale out and take some off every time you slide your stop up. It depends how many contracts you open up. Like if you open up 10 contracts, every time I'd slide my stop up, I'd probably take off 1 to 2 contracts just to continue locking in profits. But it's not about catching the whole move. It's about getting consistent wins. 20, 30, 40% is fantastic. When you get these big $1.50, $2 moves and you make like 100%, 200%, those are fantastic days, of course, but it's unrealistic to pretend that you're going to catch those every day. And if you see someone constantly saying that they do catch those every day, it's because they're lying. But anyway, again, I really hope this helped you. And if you have any questions, feel free to leave comments and let me know if you have any suggestions. And I appreciate your time and watching. Thanks, everyone.